3 days without gains on the S&P 500. Trying to change that this morning. Live from New York City. Good morning. Good morning. Your equity market positive 0.3% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
From New York, coming up as the market prices Fed cuts, the BOJ considers hiking. Wall Street favorite Nikki Haley taking the spotlight, and SpaceX could be valued at $175 billion or more. We begin with the big issue: stocks meet gravity.
Stocks have just rallied too much, too quickly.
This rally is getting a little tired.
It's just kind of a chillax.
It appears that Santa did come early this year.
Santa Claus definitely showed up early.
We've had the great rally.
This November rally.
Big rally we had in November.
It was very strong.
All of it is predicated on this idea that we're going to start to see rates move lower as soon as the first quarter.
It seems to be very strongly linked to moves in expectations around Fed funds rate.
Are they going overboard? Maybe so.
The markets have really pushed the envelope here to such an extreme.
The headwinds for the economy next year are woefully underpriced into market sentiment.
By the end of December, first weeks in January, that's when we get that uh-oh moment and that we went too far.
We'll see if the Grinch ends up coming in December.
Let's have that conversation right now. Morgan Stanley's Matt Hornback, Double Line's Jeff Sherman. Gents, always great to catch up with you both. Matt, first to you. I've asked this question a few times in the last 24 hours. Can the growth inflation mix get any better than this?
Well, we'll find out tomorrow when the non-farm payroll report comes due. But I do think that the mix is quite supportive for now for the types of price action we've seen in markets. But John, just over the past 5 days, we've seen equities go nowhere, rates go lower, and the dollar go higher. That's not a combination that sits very well with me. It makes me feel like the markets are sniffing out something more nefarious coming our way.
Well, let's get into that. Two things jumped out yesterday. Crude dropped into the 60s. And then, Jeff, we saw the 10-year at 4.1%. I think framing matters. I've talked about this a few times. I'm sure you have as well. Do you see that as ingredients for a re-acceleration in the economy, or maybe a sign that something nefarious is just around the corner?
Well, you can interpret it both ways. That's the challenge with it, Jonathan, is that again, looking at the global commodity picture, it's not just oil, but if you look at the industrial metals as well, copper's really struggled too. And we use that kind of as a bellwether or barometer of the global health of industrial production. And so as I look through it, I agree with what Matt said too. It is kind of strange that, we've had this high correlation. Everything's been predicated on lower rates. And, you didn't get kind of a fallout in the area. But if you look at the credit markets, spreads widened a little bit, but I don't think it's that nefarious there. But I think, as Matt said, we're all going to be focused on the non-farm payrolls tomorrow. The ADP report is a little weak. We've seen a big disconnect between ADP and NFP over the recent periods. So we'll have to see what that looks like. But the data is indeed slowing. And so you said, does it get any better? I think the only way it gets a little bit better is you have lower inflation. I think we have seen peak growth in this cycle on a year-over-year basis. And so I think what you're doing is seeing the settling in. I think we got a little excited about the rate moves upward. And now it's just been this kind of FOMO trade on rates on the way down that it's an under-owned asset right now. People hated bonds all throughout the summer. And once you got a little bit of a rally, you've seen a lot of people pile in.
Jeff, you mentioned the data. Let's talk about the data and how this market might respond to it. Tomorrow, 186 is the estimate. What is bad news for this market? What would it take?
Well, yeah, I think it's sub 100. I think if you get less than 100,000 or so, definitely if you get something like 50 or something, that would be really negative. And I think you could really see us kind of test the 200-day moving average in the 10-year, which is closer to 4%. But in general, if you got something like a 225, 250, I think rates back up again. And then the question becomes, do stocks like it or not? Maybe because they haven't rallied for a few days, they do like it. But in general, I think that, looking at that data, I think it's important, but at the end of it, I just don't see the labor market slowing down completely yet. You look at continuing claims. It was a nice surprise that the continuing claims went down a little bit relative to estimates. And so, again, it's really a mixed bag. And I think that's why you're seeing such big swings in rate markets, is that you have this cross section of economic volatility right now, that there's something for everyone, the bulls, the bears. But in general, I do think that we are indeed slowing, and rate hikes are starting to really bleed into the economy, but they're just not completely there yet. And so the question is this a slowdown for real, or is it something where we are approaching that area? Because the bond market is now pricing in roughly a hike by the March meeting. It's like a 70% chance today. So I think the bond market is sniffing out that they want rate cuts. The question is it rate cuts for the sake of rate cuts, or do we need it because we are too tight in policy and the economic data is slowing and warrants those cuts?
Yeah, Jeff, you nail it. Not all rate cuts are created equally. Matt Hornback, if we get rate cuts, why are we getting rate cuts?
Well, I mean, it could certainly be for one of two reasons. One, it could be that inflation is just decelerating more quickly than the Fed had expected it to. We are thinking the Fed will lower its inflation projections when they meet next week for the SEP. And that should allow them to lower the level of interest rates that they're projecting in their dot plot. So it could be because inflation is coming down. It could also be because the unemployment rate has picked up more than they had thought it would. The labor market is a lagging indicator of economic activity, but inflation is even more lagging. And so you could have a situation in which inflation fails to continue to move lower in the near term, but the unemployment rate picks up more strongly than the Fed had anticipated, and that could result in rate cuts more than what the Fed is expecting to deliver at this point.
Unemployment tomorrow, the estimate 3.9%. Payroll's just around the corner. Jobless claims behind us. Mike McKee is with us to break it down. Morning, Mike.
Morning, John. Jobless claims not signaling a problem for the economy at this point, as both initial claims and continuing claims fall or stay in a range. Initial claims 220, up only 1,000 from last week, and you can see the downturn for continuing claims, 1,861,000 from 1,925. So at this point, we're not seeing any surge in layoffs. We do have a problem adjusting seasonally around this time of year, but in general, the labor market looks pretty much the same way it has for quite some time. We'll see tomorrow when we get some numbers. Affecting the markets in the meantime, though, we have this great 24-hour period before we get to the jobs report that'll affect the U.S. markets. It's the Japanese markets because Kazuo Ueda, the Japanese bank governor, said in testimony to Parliament that their policy will become even more challenging from year end and heading into next year. Well, the markets have taken that as the end of yield curve control. They do meet next week, but they're not expected to do anything then. We get a new inflation forecast at their January meeting. The Shunto wage talks, this sort of countrywide wage increase that comes into play in March, could affect the March meeting. But right now you have people in Japan betting on a rate increase for the first time in April, which is pretty much where the U.S. market is for the Fed. So we'll see if we're getting contrasting monetary policy at that time. You can see what's happened with yield curve control. The markets are basically have pushed the yield curve out of the target, and they've sort of abandoned the target, but they haven't officially abandoned the policy yet. We'll see what happens. It's obviously having a major impact in the currency markets today, and to a lesser extent in the bond markets.
It's hard to call the JGB market a market. Mike McKee, we often say that. Mike, thank you. Check out dollar yen. Mike just said it. Dollar yen gap in lower. Biggest one-day move lower on dollar yen since the start of the year. A break of 145, 144.82. Matt Hornback, this is your world. What should we be expecting from the BOJ?
Well, we do think the BOJ brings to a close both its yield curve control policy as well as its negative interest rate policy in January. The question for markets in what happens with dollar yen thereafter is how many rate hikes can the market price in for 2024? Now, our view is that the Bank of Japan will raise rates at some point later in the year, but there's a lot of debate about that. And you know how these markets go. You give the market an inch, it'll take a foot. And so we're really trying to figure out what is the appropriate amount of risk premium for the bond market to price in for a continuation of rate hikes, and then how easy will it be for the Bank of Japan to deliver those rate hikes, provided that the ECB and the Bank of England and the bank and the Federal Reserve are all cutting rates mid-year. That's going to be quite a challenge because you can take dollar yen a lot lower than what we've seen just over the past week or so, And then all of a sudden that raises questions about the sustainability of the imported inflation that has ultimately crept into some of the underlying metrics that the Bank of Japan has been so focused on.
Jeff, limited spillover to treasuries this morning. Yields up across the curve, but only by a handful of basis points. That's kind of been an average move over the last couple of months, I imagine. From the standpoint of you and the team, Jeff, what kind of spillover would you expect from what's developing in Japan into developed markets elsewhere?
Yeah, I think, there was this idea that, that starting to price the hikes in Japan were leading to some of the rate move we saw over the course of the late summer, early fall here. But ultimately, I think, you're talking about a convergence of policy. As Matt said, the expectations are for the BOJ to hike, and you have the Federal Reserve cutting. So that's why you see this kind of wild move in the yen today as well. But I just don't really see there being a lot of spillover effects. I mean, I don't really see this idea that ultimately there's going to be this massive repatriation of the Japanese holdings and treasuries back to their own local currency at this stage. And so I think some of that move has happened in like corporate markets. We see that anecdotally about the demand for that Japanese investors, not really as much the overall pension system, but the bigger investors ultimately I've been buying European corporate bonds. So I just don't see there being this effect of a spillover to the treasury market at this stage. Maybe the treasury market's a little overbought just given the momentum. If you look at strength and RSI kind of stuff. But in general, I don't expect there to be some meaningful pushback and U.S. rates to go up because there's this massive selling because people want to go back to the Japanese currency.
Jeff, it's another anchor, though, that's been around the neck of the global bond market for the last few decades that's potentially being dropped. And I just wonder, as you look out to next year, do some scenario analysis with us. If we get that economic downturn in America, do you see limits to the Treasury rally at the long end, given the forces elsewhere?
Yeah, absolutely. I mean, because the rhetoric over the late summer was the sustainability or the tenability of the deficits that we're running in this country. And it's on every trader's mind, it's on every portfolio manager's mind, and that there needs to be some more term premium in the market because of this increased supply. So it's a technical issue, but you have to find demand, and demand comes when you essentially have the right price. And so what I would see is that we expect to see, if there's an economic downturn, a rally. But as I say, you don't really want to own 30-year bonds for 30 years. We want to rent them. We want to rent them for a rally. I do think they do have a meaningful move, but I think the magnitude of that is less than what we've seen in previous cycles, because now we're back to having a world that we've seen inflation. We know that the fiscal response could be massive, and I think that will be on traders' minds as well. So I do think you still get a rally. I just think that it's not as meaningful as it would be in past cycles. Because again, we've seen inflation. We need to price inflation back in the market. And we see that if there is a big dose of fiscal, which we've had a constant fiscal dose really for the last decade, but if they do it in the magnitude, if you just did half of what we did during the pandemic, I can see you getting a sharp reversal in rates. And it's probably the pressure valve there would be the dollar. And so the way I would try to play that through that is you want to own the rates going into it. You want to be long the dollar, but effectively, if you start to see that fiscal response mechanism, ultimately that's your cue that it's time to really start looking at the international markets and get out of some of the dollar and probably get out of some of those back-end rates positions. We've moved our key rates down a little bit with this rally, the stuff we own in the back end. We think a little bit of this went a little far, but again, we still own duration. We just moved it in the curve a little bit more to like the 10-year and 20-year parts of the curve.
Interesting. Save that dollar call because Matt Hornback, I know, has thoughts. We'll get to them in just a moment. Matt Hornback, Jeff Sherman. Looking at the market right now, equity futures positive by about 0.3% on the S&P. Let's get you some movers. Here's Abby.
Helping that positive tilt, John, let's start off with the shares of JetBlue. They are up more than 8%, or at least the last time that I saw them. This after JetBlue, the airline company, tweaked its fourth quarter guidance to a narrower loss on both the top and bottom line. They're talking about healthy travel demand, and that's why they're able to boost that fourth quarter revenue guidance. AMD up nearly 3%. They unveiled their AI chip yesterday at their big event, a competitor to NVIDIA. And I think also investors really liking the fact that CEO Lisa Su said that the AI chip market could be as large as $400 billion over the next 4 years. To the downside, though, Nikola down 23%, plunging on its plan to raise capital via both stock and converts. The former leads to dilution clearly. The latter could. The stock into today down 55%. There's a 20% short interest. Tough year for Nikola, John.
Abby, thank you. Great interview with Lisa Su and Ed Ludlow. We'll bring you some of that. We'll catch up with Ed in about 15 minutes' time. Look out for that. Coming up next on this programme, Haley under fire in Alabama.
You have other candidates up here like Nikki Haley. She caves anytime the left comes after her, anytime the media comes after her.
She should come nowhere near the levers of power, let alone the White House.
GOP candidates targeting Nikki Haley as she continues rising in the polls. That conversation up next.
You have other candidates up here like Nikki Haley. She caves anytime the left comes after her, anytime the media comes after her.
The only person more fascist than the Biden regime now is Nikki Haley.
When she was governor of South Carolina, she was the #1 ranked governor of bringing the CCP into her state.
She should come nowhere near the levers of power, let alone the White House.
Her donors, these Wall Street liberal donors, they make money in China. They are not going to let her be tough on China, and she will cave to the donors. She will not stand up for you.
Nikki, I don't have a woman problem. You have a corruption problem. And I think that that's what people need to know. Nikki is corrupt.
I love all the attention, fellas. Thank you for that.
She was sharp last night, and Nikki Haley taking a spotlight at the 4th GOP debate, willingly or not. Her opponents criticizing her ties to Wall Street. Haley's major backers, including JP Morgan, billionaire Bill Ackman, industrialist Charles Koch. Even with that support, she's still in a distant second place compared to frontrunner Donald Trump, who hasn't attended any of the debates. The latest Wall Street Journal poll showing the former president with an unchanged lead of 59% and Haley rising to 15% in recent months. Bloomberg's Anne-Marie joins us now from Washington, D.C. Morning, Anne-Marie.
Good morning, John. Well, it's the race for second place, and given the momentum we have seen from Nikki Haley amongst those 4 that were actually on the stage, I guess we should potentially call it a candidate forum rather than a presidential debate. Nikki Haley was the one that drew all this criticism, especially from Governor Ron DeSantis and Vivek Ramaswamy. They went after her in terms of Wall Street donors that are interested in her, even a potential billionaire Democratic donor who gave $250,000, Reid Hoffman, to her super PAC, and also for her hawkish foreign policy. At one point, Vivek Ramaswamy called her a fascist neocon with lipstick. She didn't let it bother her. She said, I love all the attention, fellas, and at one point even said they were jealous for all that attention and the donation she's getting. Because those Wall Street donors, remember, Jonathan, about 6 months ago, thought potentially Ron DeSantis was going to be their guy, and they're now looking to Nikki Haley.
MH, when you look at the backers, the likes of JP Morgan CEO Jamie Dimon, are they backing her because they want her to beat Biden or they want her to beat Trump? And does that help her win these primaries?
I think it depends on who you ask. But when you look at some of these major Democratic names, there's a potential they're going to vote for a Democrat when it comes next November. But they are concerned that if Trump becomes the nominee, obviously there's potential that he could beat Biden. And you see how well he's doing in the polls, especially when you look at our polling of swing states. Trump is leading in a number of these swing states where elections are won or lost. And that is why there is growing concern. That's why you see some Democrats saying, for the health of the country, we should make sure there's an alternative to the former president. Former president, though, Jonathan, yesterday didn't do counter programming. He didn't care. He had a private fundraiser. And if you look at the latest Monmouth University polling, when it comes to Republican voters, 63% say they want Trump and only Trump. 28% say they want a contested election.
AMH, thank you. Down in Washington on the latest. Matt Hornback, Jeff Sherman with us for some final thoughts. Matt Hornback, messy politics potentially next year, big deficits. We're talking about the prospect of rate cuts and slower economic growth. Matt, you like the US dollar for next year. Just walk us through it.
Yeah, absolutely. Well, we think there's a couple of things to like about the US dollar. Number one, it's certainly one of the higher carrying currencies in the G10 complex, and carry is king at this point. So we like the dollar for its carry, but we also like it for its defensive properties, John. If we have a U.S. slowdown that's occurring at the same time that Europe continues to be quite weak and China is having difficulty rebounding despite all of the stimulus that's been thrown its way, that's not a great environment for global risky investments. And so we think that the dollar can benefit from that type of environment as well. The real risk to this view, of course, is that the Fed, has already made a policy mistake and finally figures it out. And so to the extent that we have the Fed cutting rates more aggressively than Seth Carpenter and Ellen Zentner are calling for at this point, that would certainly be a risk to our view for the dollar. But for the time being, we think the dollar will continue to grind higher from these levels.
Jeff Sherman, are you on the same page?
Yeah, I am. I just think that the market's a little excited about these cuts. And, I've said it before on the programming here that, when the Fed cuts, I think it has to be a meaningful cut. And this idea that there's going to be some preemptive cut to tweak policy and do it around the margin, I'm just not in that camp. And, when we look through it, I mean, look, the reason Jay Powell brought up something like Supercore is because he knows it's got some sticky attributes, I believe. And so it allows him to keep that policy. So I think by the time, in order to get a Fed cut, you've got to see some meaningful degradation in the labor market. And as Matt pointed out earlier, it's one of the most lagged variables besides inflation. And so the stickiness of the super core, yes, it's trending downward. Yes, it's a sub 4 at this point, but it's just not where it needs to be. And, if you look at services inflation, it is even in core CPI, it's still pretty sticky. So we think inflation, the headline level goes sub 3 in the first quarter, but I don't think that's enough to get the Fed to do some sort of preemptive thing. They told you there's going to be pain. They want to be tight. And Jay Powell's legacy, he doesn't want to be thought of as someone who caters to, the administration or caters to the overall kind of the populace and the markets. And him talking about financial conditions in the last FOMC press conference, I mean, look at how the financial conditions have moved against him in his face.
True.
And so I kind of expect him to sound hawkish. I don't think there's much that he does, but I just don't think, I think he's trying to tell the market that we're not delivering a cut. Quit pricing it in, and I think you get some whippy behavior off of that.
Big news conference next week. Jeff Sherman, Matt Hornback, gents, two of the very best. It's great to catch up. It always is. Coming up on this program, the morning calls and later, SoFi's Liz Young calling it a market of big contradictions. That conversation still ahead. Stocks are positive across the board here. That's some of the price action. Let's get you some morning calls. Your first one from Bank of America, downgrading Take-Two to neutral, assuming a later launch of its highly anticipated GTA video game. Goldman Sachs initiating coverage of Avis with a sell rating, pointing to a negative risk reward and limited upcoming catalysts. And finally, Stifel initiating coverage of Rivian with a buy rating, $5 price target, expecting headwinds to start easing over the next few years. That's stock positive by 3.9%. Coming up, SoFi's Liz Young seeing a challenging start to the year for stocks. That conversation up next. Your opening bell just around the corner. 24 seconds away from the opening bell this morning. Good morning. 3 days, no gains on the S&P 500. Let's see if we can make a change to that. On the equity market right now, futures session highs going into the opening bell. Equity futures positive by around about 0.5% on the S&P. On the Nasdaq 100, futures here positive by almost 0.75%. There's your opening bell. Switch on the board and get to the bond market. Yields shaping up as follows on a 10-year. Yields higher by 5 basis points. 4.1533. Yesterday, this market spooked by 4.1% on a 10-year and crude in the 60s. We unwind some of that. WTI $70 and about 20 cents, up by 1.2%. Is it all about supply or is it all about demand? Depends how bullish or bearish you are right now. But intriguing to me that people were saying it was all about demand, yet stockpiles yesterday were falling. In the latest data we got from the government, $70.24. My opinion on this does not matter. Paul Sankey of Sankey Research says this is all about supply and not demand in this oil market. More than 13 million barrels a day of crude production in this country right now. In the FX market, 107.80. Matt Hornback on the euro sees potential to go to parity in his latest research. We're just a little firmer here by 0.1%, a stronger euro trying to make a comeback from recent declines. That's the cross-asset price action about 50 seconds into the open. Positive here across the board. One stock to watch at the open, Dollar General. Shares moving higher on better than expected Q3 results. Abby has more. Hey, Abby.
Hey, John. Better than expected and better than feared. As a result, the stock, to your point, is up 4%, the best day since the middle of October. And it really has everything to do with the fact that numbers were better than Wall Street estimates. In terms of same-store sales, they fell 1.3% versus the estimate of a 2.1% decline. They also beat earnings estimates by about 7% to put up $1.27 in adjusted earnings on about $9.7 billion in revenue. They backed, importantly, the guidance for the full year. This company's really been struggling. The CEO highlighted significant headwinds that they have made relative to inventory shrink. They've also made momentum in some of the underlying sales trends, positive customer traffic, as well as market share gains in both dollars and units. Now, looking ahead, they do have more than 2,300 real estate projects that they're planning in terms of opening new stores, remodels, relocations, and to make other improvements. That's what they're looking to do, John. Into today, it's been a tough year, down 46%. They've got their work cut out for them. Small start, stock liking it right now, up 4%.
Nice little pop. Abby, thank you. 2 minutes into the session, let's stick with earnings. GameStop reporting sales that fell short of estimates. Alex Semenova has the story. Hey, Alex.
Hey, John, good morning. Well, it was that sales number that was driving shares of GameStop lower this morning, coming in at just under $1.1 billion below Wall Street estimates and down 9% from the same period a year ago. GameStop missed in sales on all three major categories. That's software, hardware, and collectibles. Now, analysts said that this report was mixed, although they flagged revenues that missed estimates. They did highlight costs as a positive. Baird Equity Research said that the company is right-sizing its stores and headcount. Jefferies pointed to notable cost discipline. Now, John, get this. The company also said that the board has given CEO Ryan Cohen permission to invest in equity securities and manage its investment portfolios. Wedbush called this the most inane move they've ever seen. They said that we don't need GameStop acting like a mutual fund. John?
Alex, thank you. Thanks for the update. The stock is down by around about 6%, down about 25%, I believe, on the year so far. Let's turn to AMD, the chip maker unveiling a new AI chip after giving a monster forecast. Ed Ludlow wakes up early for us. Morning, Ed.
Yeah, good morning, Jonathan. AMD up more than 3%, putting it on track for its biggest jump in about a month. It's curious because the announcement was yesterday lunchtime and the stock actually closed lower on Wednesday. But the crux of it is that the MI300X, the new AI accelerator, is a direct competitor to NVIDIA's H100, the GPU that we've been talking about all year. It has a technological advantage in that the AMD GPU has something called HBM3, which is the latest cutting edge of high bandwidth memory. High bandwidth memory reduces latency, it makes it more power efficient. And when I was chatting with the CEO, Lisa Su, yesterday, the main point is that it's a cost competitive product against NVIDIA. In fact, on stage, Lisa Su spent most of her time explaining why, on various factors, the MI300X was better than NVIDIA's current generation H100. NVIDIA plans to catch up on HBM3 or high bandwidth memory in the second quarter next year when they come out with the H200. What's pleasing the analysts is they gave us some meat on the bones of who's actually going to buy this GPU. It's not just Microsoft Azure that's going to be a cloud customer. Meta is going to put the MI300X into its data centers. And there's also a relationship with OpenAI in terms of the cloud tools they offer to developers in building AI and other software materials. Now a big move, up 4.3%, somewhat delayed. The headline that you talked about, they've upgraded their 2027 call for the total addressable market for AI accelerators to $400 billion. Just in August, they said it would be $150 billion. I asked what's changed. The demand has changed. It's increasing exponentially, John.
Ed, great work with Lisa yesterday. Just how surprised were you to hear numbers like that?
Surprised in the sense that we knew about the MI300X. I think that the only new information really beyond the updated forecast for 2027 was who the specific customers are. Remember, there are still some supply constraints, right? The contract manufacturers like TSMC are not able to build the total volume of GPUs that names like NVIDIA want. So that's a factor in it. One key note of caution, they did not update their financial guidance, right? They still see $2 billion of sales in 2024 AMD on the MI300X. And I asked Lisa, well, if you're going to upgrade your 2027 call by that extent, why not upgrade the 2024 call? And she said there is certainly room to surpass that $2 billion target.
Interesting. That's what's behind this move this morning. Ed, thank you, sir. We're up by, let's call it 4.5% on AMD. This is real. It's not just a hope and a dream. It's real. That demand is coming. It's materializing. You see that in NVIDIA all year. Let's stick with AI. Alphabet releasing Gemini, its latest and most powerful AI model. Simone Foxman on top of this one. Hey, Simone.
Hey, John. Yeah, we're seeing a delayed reaction here in the shares of Alphabet as well after Google rolled out its Gemini AI model. It did that yesterday, and there was a pretty muted reaction, but now we're seeing a substantial move higher in these shares. Now, Google invented the technology behind the current AI boom, but OpenAI and its ChatGPT and DALL-E have really taken a lot of the popularity. So Google wants to get back into the game with rolling out this Gemini AI model, which is usable through the public through the chatbot Bard. There are 3 different versions of this technology, and not all of them have come out. One, Gemini Pro, that's currently accessible through Bard. Gemini Nano will be accessible for Pixel 8 Pro, Google's flagship phone. But Gemini Ultra is the one that everyone's paying most attention to. It is not currently available for the public. It will be rolled out to enterprise and developers, but not for the public until next year through Bard. That's the one that is, according to Google, more powerful than ChatGPT 4. It's natively multimodal, meaning it was pre-trained to take inputs that are both text and images and do stuff with them. The goal here for the company is the AI that feels more like a helpful collaborator and less like a smart piece of software. Again, we didn't see a big movement in the shares yesterday, and JP Morgan says perhaps this is because some analysts viewing this product as not quite complete and the fact that Ultra has to come out next year. But BI's Mandeep Singh pointing to the potential distribution advantage for Alphabet versus OpenAI. So maybe markets just slower to process this news, and that's what investors are computing this morning, John?
Tony's better this morning. Simone, thank you. Just a lift across the board here. The stock is up by more than 5%. The broader market up by 0.5%. The Nasdaq up by 0.9%. Here's the outlook. This was the conversation I've looked forward to all morning. So far is Liz Young, weighing in on the state of markets and writing the following. Markets are wrapped up in contradictions, at least for the rest of the year. And the glass half full side is still winning. Liz, I'm pleased to say, joined us right now. Liz, I've been talking about your note a little bit earlier this morning, a market of massive contradictions. Can we just pick out a few of them?
Well, you've already covered a couple of them. Think about the oil market. We've got oil prices falling at a time when cyclical stocks have rallied and started to really catch up to those top big tech names. So the stock market seems to think that cyclicality is still alive and well. The oil market is a little confused about that, and we're having a debate over whether it's supply or demand driven. And then you've got things like just markets versus the economy in general. Obviously, we've seen a really strong rally in markets this year at a time when we've intentionally cooled the economy. Now, things have held up better than I think many expected, but we were welcoming and are still welcoming some cooling in the data. So there's a little bit wrapped up in that. And then if you look at things like just holiday spending, so some of the topics of the moment, we had retailers come out with Q3 earnings and a lot of their outlooks saying that they were worried about demand softening. They hadn't built up quite as much inventory, and they'd really cautioned about results being lackluster. And now we've got holiday results that are saying consumers were spendy before, they're still spendy now, and things are doing okay.
Liz, let's go through that. 3 points there. The broader market, the relationship with the economy. Then we've got crude and what's happening with the consumer. I want to talk about the consumer. What's important to you? How much they're spending or how they're spending? Does buy now, pay later mean we should be concerned?
My personal opinion is yes, it does mean that we should be concerned. Now, there are all different types of deals out there in buy now, pay later. You can do it at 0% financing, or you can do it at 18% financing. I would argue, though, if people are only doing BNPL for a couple months, what would really be the point? Unless they're taking that money and investing it into something that's going to earn them more over that couple-month period and engaging in some kind of interest rate arbitrage, which is not what I think is happening, then I do think the BNPL, the growth of BNPL, particularly this holiday season, on the heels of so much growth in credit card debt, auto loan delinquencies in the subprime sector, it's just all adding up to tell me that consumers are starting to overspend, if not already overspending. So that may not come home to roost this year, but in January and February, when some of those bills come due, we need to be careful and watch what's happening with delinquency rates and watch what's happening with consumer spending early in 2024.
So let's fold in crude. Right now, $70, yesterday in the 60s. You mentioned it. How do you frame the move in crude? Is that something that's going to help consumers or a sign that maybe some pain is just around the corner?
Well, it's clearly going to help consumers at the gas pump. I mean, gas prices have come down quite a bit. That's definitely freeing up some more disposable income for consumers. They've been under pressure because of that all year. And that's really been some of the big story about inflation, is that the non-negotiable items like food, shelter, gas to get to work are what have really been crimping the consumer spending pattern. So that's certainly a tailwind for consumer spending in the short term. If you zoom out and look at crude prices. Now, obviously, there are arguments to be made for this is supply driven. I do think over the long term, crude prices will be supply driven. But over the near term, that really big drop in crude after we got an announcement of further production cuts didn't make a ton of sense for the supply story. So it tells me that the market is looking ahead and saying, we're worried about demand. It could be a lot of out of Asia. It could be worries about China demand and just not this resurgence in demand that we were expecting. But that doesn't bode well for the global economy in general if we're worried about demand continuing to soften. I do think that crude prices will recover, and I think that we will settle out above where that big drop actually happened. But it did send a signal that there were concerns over cyclicality.
So this has been a big topic of conversation for us this morning, as I'm sure you know, Liz. So I'd love your thoughts, just to put a bow on it. You see the move lower in crude paired with the move lower in yields, not as ingredients for a re-acceleration in this economy, but a reflection that maybe something worse is just around the corner. Is that right?
I think it's just the consternation in investors that something worse could be around the corner. We've been hearing ad nauseum that demand is going to soften. We needed demand to soften in order to take care of the inflation problem, the global inflation problem. So now it's happening, and there's this nervousness about, okay, we wanted it to cool, but is it cooling too fast? We want to make sure it doesn't cool too fast and go too far. So we're at this point where we're trying to figure out if cooling is going to tip over into contraction. And I think investors are just trying to make sure that they're positioned for either direction. It feels like a coin toss, and it may continue feeling like that through the end of the year.
So what would you be advocating for in the stock market, Liz, right now?
Yeah, you know, what's interesting in the stock market is that there's a lot of rotation going on under the surface, but it doesn't seem like there's a ton of new money coming in. It's the rotation out of this year's big winners into this year's big laggards. And I think that that makes a decent amount of sense right now if you're worried about missing out on any further rally. When you look into 2024, the question will be answered of whether or not this rally is lasting by people taking money out of money markets, out of treasuries, and putting it into risk assets. Personally, I don't think that that's going to happen in a huge wave. I think there's going to continue to be consternation. There's going to continue to be worry about whether or not things will slow too much. So where would you position in the stock market? Number one, if you're looking for growth that isn't as interest rate sensitive, healthcare is a good option for that. And number two, I think you do have to be positioned somewhat in the consumer, but I would go on the consumer staples side, just judging by what's happening in discretionary and the volatility of discretionary spending, especially on the heels of all of this credit buildup. And then you can still be in things like utilities, be in some of those defensive sectors, instead of just trying to chase the FOMO trade in tech.
So utilities, top of the pile yesterday, leading the way. Liz, thank you for the update on the big contradictions in this market right now. Liz Young there of SoFi. Your market at the moment, about 14 minutes into the session, advancing by, let's call it 0.5% on the S&P, doing nicely on the NASDAQ. Coming up on this program, Elon Musk's rocket company could be worth $175 billion.
They'll say, what's the fastest way to make a small fortune in the rocket industry? And the punchline is you start with a large one.
SpaceX discussing a potential tender valuing the company at $175 billion. That conversation up next.
They'll say, what's the fastest way to make a small fortune in the rocket industry? And the punchline is you start with a large one. So, it was tough going for a while. Our first 3 launches failed. Fortunately, the 4th one succeeded. If the 4th one had not succeeded, SpaceX would not exist.
That was Elon Musk back in June. Fast forward to today, SpaceX could be getting a major valuation boost. The company initiating discussions about selling insider shares at a price that values it at $175 billion or more, according to our reporting. The tender offer could range from $500 million to $750, with shares offered at about 95 apiece. This coming amid other positive developments as its Starlink system clears months of US military testing in the Arctic. Let's get to the team coverage. Ed Ludlow in San Francisco, Katie Lyons in D.C. Ed, you help lead the reporting on this. What are you hearing?
Yeah, look, it's a pretty big jump from a tender that only just happened in the summer where the share price was in the low 80s. As a reminder to the audience, a tender is where employees and insiders can sell shares to outside investors. The price is set between the CEO or the CFO or COO of SpaceX and then the lead investor on that round. But $175 billion would value SpaceX within the top 75 companies globally if you're going to give a proxy against publicly traded companies. And a lot of people ask, well, what's it based on? And as you know, John, we've reported a little bit about some of the financials, the expectation that next year there's going to be a really big jump in revenue from about $9 billion in 23 to $15 billion in 24, where Starlink becomes the majority of revenue as opposed to the business of launching things into orbit.
Well, let's get to Starlink. Katie, I mentioned some positive developments. What are they?
Well, after 9 months of tests that concluded in June, John, Starlink, which of course is this satellite system that operates under the SpaceX umbrella, has passed U.S. Air Force tests in the Arctic. An Air Force research official essentially saying it found Starlink to be a reliable and high-performance communication system in the Arctic. Now, the Arctic is difficult for military communications, John, because it is a pretty rough climate. And through these tests, Starlink equipment was essentially put through high winds and very cold temperatures and was found to perform well. This potentially could open the door to SpaceX getting Pentagon contracts in the Arctic region, a region, of course, which is very important competition-wise when it comes to the China and Russia, which are both looking to exercise more influence in that region specifically. And this could just be another addition to the SpaceX portfolio of business it does with the Pentagon, knowing, John, that Starlink already is very much involved in Pentagon business. There's been an undisclosed contract between the Pentagon and SpaceX for the Starlink operations with the Ukraine military, and this could potentially just see this relationship deepen and even further.
Ed, one final question for you, sir. There is another way to exit, IPO. What's going on?
Yeah. Well, this is why I think there's such an insatiable demand to get into this tender offer, right? It's not a primary offer where SpaceX issues new equity, but it is a mechanism or last chance for investors that aren't already on the cap table to get in ahead of a potential Starlink IPO or spin-off. We've reported that that could happen as soon as the end of 24, beginning of 25. And we know that behind the scenes, some of the incorporation and legal work to put Starlink as a separate entity is underway. So it's kind of last chance saloon. If you want to get in now, and wait for the big IPO spin-off that could come in a couple of years' time.
Ed, thank you, buddy, for the update, alongside the brilliant Kelly Lyons down in Washington and in San Francisco, respectively. About 22 minutes into the session, broader price action pretty decent, up by 0.4% on the S&P, just off session highs on the Nasdaq, still up by, let's call it 0.6%. Let's get you some sector price action. Here's Abby.
It's pretty bullish, John, not surprisingly, with that gain for the S&P 500. We have broad participation in today's rally, led by communication services. This has everything to do with Alphabet and that AI chip that Simone was talking about earlier. Processor up 2.81%. The sector overall. Energy getting a little bit of a lift here, up 0.8%. To the downside, we have utilities and healthcare. Those are defensive sectors, as you know, John. So this actually makes it more risk on, the fact that people are not seeking safety from a sector standpoint. Now, over the last number of weeks, we were talking yesterday about the regional banks. Now let's take a look at the S&P 500 financials into this week, up 5 weeks in a row, gaining about 14% over that time period. Right now, we're looking at a small week loss on the week. These are largely the insurers, but in any case, really a nice win streak for the financials, one of the top sectors over that time period, John.
Abby, thank you. OK, coming up on this programme, the trading diary. I'll share the estimates in the payrolls report that drops tomorrow morning, and you get a little peek of the lineup for tomorrow's show. From New York City, this is Bloomberg. Almost 26 minutes into the session, stocks doing okay on the S&P, higher by 0.4%. That's the price action. Here's the trading diary. Coming up, the payrolls report tomorrow morning. Tuesday, CPI print just around the corner. Next Wednesday, US PPI numbers. Fed decision. Chairman Powell news conference Thursday. It's the ECB's turn. I promised you the estimate in our survey for tomorrow morning. 186 on a headline number. 186. The previous number, 150. That number, the latest one. This is going to move around as we get more estimates going into tomorrow morning. The lineup, world class, as I always say, the best anywhere on the planet on payrolls Friday. Mohamed El-Arian, Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM, all of that still to come tomorrow. From New York City, for this morning, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This is Bloomberg.